Timothy. Hi, morning. You've recently downgraded India to market weight. You see also a risk to earnings growth. Only 5% growth in 2013 is what you've assumed. What makes you so bearish on India?
Yeah, I mean, I'm not saying I would characterize those numbers as ultra bearish, but they certainly are much more restrained and subdued than was the case before. And the logic is very straightforward. We have taken our GDP growth numbers down, and the reason for that links directly into what we were just talking about, which is that India does unfortunately have a lot more external vulnerability than pretty much any other economy in the region. And so those concerns about external funding and also about internal imbalances, notably in the fiscal side, have prompted a greater concern over the currency, which of course has moved and depreciated quite significantly. So as a consequence of wanting to curtail further rapid and possibly uncontrolled currency depreciation, the Reserve Bank of India has recently imposed some tighter measures. And so this tightening of monetary policy comes at a time when, from a purely domestic economic standpoint, India probably would be benefiting from some more accommodative monetary policies. So the point here is that we've had an unexpected tightening of monetary policy, and that comes at a time when growth is weak. So we've taken our growth numbers down further still, about 40 to 50 basis points down for both this year and next. And the combination of tighter liquidity and lower growth naturally spells some further pressure for corporate profitability. So we've marked down our corporate earnings numbers to the magnitude that you've just suggested. And against that backdrop, and with less of a likelihood that we see valuation recovery, that suggests that the prospects for the equity market are correspondingly more subdued, hence our downgrade.
Timothy, liquidity has been a worrying point for the Chinese credit system. PBOEC removed the lending rate floor as well. How are you viewing this move?
Well, I think the key issue here is the broader outlook for China and positioning and contextualizing the recent moves by the PBOC in the bigger picture. And our view here is a couple of things. Number one, that the tightening of interbank rates, which we saw in June, was a deliberate one. There was an overshoot for various technical reasons that we don't have time to go into, but the key point is that it does appear that the PBOC did intend to tighten liquidity. And that was in direct response to wanting to curtail some of the significant increase in lending in the shadow banking market. Now, shadow banking itself is something which has been allowed to develop and, in fact, in some cases encouraged as part of a gradual deregulation process and a development of non-banking financing channels. And the recent move by the PBOC in terms of reducing some limits on the floor of lending rates is an incremental step in that move towards deregulate overall interest rates. So the bigger picture here is that China is in the process of moving towards a freer and less regulated financial structure, while at the same time trying to preserve banking profitability, and all that in the context, of course, of having a broader and more integrated set of reforms which span not just the financial markets themselves, but also the real economy. That overall process of reform is something that, in our view, is important, necessary, and is something that will take some time to occur. And against the backdrop, we're thinking that the price, so to speak, is going to be somewhat lower economic growth. So the bigger message here is one of a trade-off between the speed of growth and the progression of reforms. And that's one of the reasons why we have a somewhat more conservative view in terms of a fundamental outlook for China than has been the case, say, 1 or 2 years ago.
Timothy, the Fed governor seems to be holding the strings of asset classes across the world, whether we look at equities or currencies or even gold. Concerns over the quantitative easing exit sparked a sell-off across Asian assets. How are you advising people to approach the eventual tapering then?
There, of course, has been a significant amount of discussion and market movement around the whole topic of tapering that the Fed has clearly signaled. And our view on this is that the bigger picture is that tapering will occur. You can argue about the timing and the magnitude of it, but it's quite clear that the so-called liquidity tide has shifted here. Now, contextualizing that, markets were quite concerned about an overly immediate and strict implementation of Fed tapering, and that's why we saw a very significant sell-off in June. We've now seen a recovery in markets as there's been a bit of a so-called sigh of relief, as there have been very clear indications from Fed governors that the pace of tapering would be more moderate than the market was initially expecting. So there's been a bit of up and down in terms of the way markets have traded as a consequence of that. But the bigger picture to emphasize here is that tapering will occur, and it's appropriate that it does if indeed the U.S. economy does pick up speed, as we think is the case. And so our expectation is that tapering will begin likely in September and continue gradually through the middle of next year. We don't think we'll get the first actual increase in Fed funds rate, the policy rate, until early 2016. But the actual timing of all this and the magnitude will, of course, be contingent upon the actual data which comes out, which the Fed has clearly signaled they will be looking at in order to calibrate their response.
On the currencies end, will the pressure continue for emerging market currencies given how dollar has fared and is likely to go ahead?
Our general sense is that there is and will continue to be pressure on many emerging market currencies. The key axis of price determination right now, or at least one of them, is the extent to which any individual economy in the emerging market domain has external imbalances in terms of a current account deficit or a current account surplus. Those markets, those economies where there are current account deficits are ones where they appear to be much more vulnerable now in the current macro environment than was the case 6, 9, 12 months ago when liquidity was abundant and the market was not worried about funding issues. So the areas where we think there is some more risk would be, as I said, in markets or other economies with their current account deficits, and also where there has been a large accumulation of foreign holdings of local currency debt. So this is why within Asia, for example, places like India, first and foremost, and then Indonesia secondarily, have been having more currency pressure because they've got current account deficits. And certainly in Indonesia's case, there's been a significant increase in foreign ownership of local currency debt in the past 3 to 4 years.
So do you see downside to growth estimates? After all, I mean, Indian central bank's measures to stabilize the currency could hit growth.
Well, that's just what I was indicating. I think we have taken that into consideration in terms of our recent update of our earnings outlook. I think for India generally, or India specifically, and then for the region more broadly, more generally, that the risk to earnings numbers still lies on the downside. To put some numbers on that, our current top-down expectations for the MSCI Asia Pacific ex-Japan index for earnings growth for this year is 8%.
Right, so at the current juncture, which are some of the key sectors, businesses or groups which are on your avoid list?
Well, India specifically, one of the areas we've become more downbeat on recently is the Indian banking sector. So our chief Indian bank analyst, Basim Inamdar, has recently lowered a number of the estimates that we've got for the Indian banks in particular. So I'd say that would be one of the sectors where we're taking a more cautious and somewhat more differentiated view within that space.
What about defensives versus cyclicals? That line of thought in India as well as emerging market Asia, especially since the valuation angle is certainly rich for names in consumption and healthcare space.
Yeah, we would concur with that. In fact, one of the trades or the investment recommendations that we have articulated in our third quarter view is a subset of the overall cyclical space, which we call the global cyclicals, which are those companies which tend to be more focused in terms of their revenues on the developed part of the global economy, some of the exporters to the United States and to Europe, for example. And the reason quite simply there is that we are expecting recovery and growth in both the United States and in Europe. And in contrast, we note that a number of the defensives, although they have admirable, stable qualities, they are, as you've just indicated, on the expensive side. The indications we have are that foreign positioning or investor positioning tends to be fairly crowded or extensive in those areas. And if we have overall taken down our growth estimates for economies broadly, that would suggest there may be some moderate downside to even some of those defensive areas. So they are aptly named defensives, but that doesn't mean they're impermeable to any downgrade in GDP growth forecasts. So for the defensives, we think the setup is they're expensive, well-known, and they're moderate downside risks to consensus earnings. Whereas some of the global cyclicals, they are less well held, their valuations are generally more attractive, and they give you a play on an improving growth profile in the United States and to a subsidiary degree in Europe. So we think that the entry point for a relative outperformance trade of global cyclicals versus defensives does make some sense at this juncture.
How big is the political risk for India as we head for elections? Do you fear reform window closing down soon?
There is any place, whether it's India or Indonesia, where there also are presidential elections that are upcoming, that uncertainty obviously injects a measure of risk into the market outlook. I think in India's case in particular, that risk is acute or noteworthy because so much of the outlook for or the foundations for a positive view on the equity market does hinge in some part on further progression with regard to reform or the implementation, for example, of much delayed and much needed infrastructure spending. So there's a lot of form or so-called low-hanging economic fruit which can be plucked and which could work to the benefit of the Indian economy, but that requires the political will to implement some of the reforms and to actually undertake some of the needed infrastructure spending. And to the extent that that's delayed or impeded by the political process, then that renders the outcome of the elections particularly important and noteworthy in this specific cycle.
Timothy, good chatting with you.